Hi, everyone, and welcome. We've arranged this discussion today thanks to the team at Pro Tax Accountant, the well-known accounting firm here in the UK.
Indeed.
They've brought us together to talk about something that touches a lot of us, really, whether you're planning for the future or maybe just curious.
hmm
We're looking at the tax implications of gifting assets right here in the UK.
That's right. And look, you probably thought about it, or you will think about passing assets on. It's not just being generous, though that's part of it. It can be quite a strategic thing to do.
Mhm.
We'll be focusing mainly on, capital gains tax and inheritance tax when you gift things. Maybe touch on income tax too, because that can pop up.
So, yeah, as you think about gifting assets, it's really, really important to get your head around the UK tax system.
Yeah.
You've got that frozen personal allowance, £12,570,
Still frozen, yeah.
and the income tax bands going from 20% up to 45%, plus CGT, capital gains tax, that can hit 24% on residential property.
Yeah.
So gifting, it needs, well, careful thought. So the big question we're tackling is, what are the main tax things you need to know about when gifting assets in the UK, specifically now in 2025? Okay, let's start unpacking this. The UK tax framework in gifting, as we said, personal allowance frozen at £12,507 for 2,526. Income tax bands 20, 40, 45%.
hmm
What's interesting is how the income from something you gift could, push the person receiving it into a higher tax bracket.
Exactly. That's a key point. If you gift something that generates income, maybe a rental property or shares that pay dividends, that income becomes taxable for the person who receives it.
Right.
And depending on what they already earn, this extra income could easily bump them into the higher rate band, meaning, well, more tax to pay on that income.
So you need to think about their tax situation too, not just your own.
Precisely. Especially with income-producing assets. It's a two-way street tax-wise.
Okay, now, capital gains tax, CGT. This is where it gets quite interesting, isn't it? Because gifting is treated like you've sold it.
It's treated as a disposal, yes,
Yeah.
at market value. And that's what can trigger the CGT.
Even though no money changes hands.
Correct. Now, there is that £3,000 annual exempt amount for CGT this tax year, which helps a bit.
Okay.
But the rates themselves, they vary. For residential property, it's 18% or 24%. For other assets like shares, it's 10% or 20%.
And that depends on the giver's income tax band.
Yes, the giver's income tax band determines whether they pay the lower or higher rate of CGT on the gain.
So just to be clear, the gain isn't profit from a sale price.
No, because there isn't one. The gain is the market value when you gift it, minus what you originally paid the base cost, plus any allowable costs like, say, major improvements you made.
Wow. So you could genuinely end up with a tax bill just for giving something away.
You could.
Yeah.
It catches people out. It's not always a tax-free act for the person doing the gifting.
And then there's inheritance tax, IHT. The thresholds here are really key, aren't they?
Absolutely critical. You have the £325,000 nil rate band. That's also frozen, by the way, until 2030. Couples can potentially combine that, giving them £650,000. And then there's the residence nil rate band, another £175,000 potentially per person if you pass your main home to direct descendants like children or grandchildren.
But anything over those amounts.
Can be hit with a 40% tax rate. It's a hefty chunk. And importantly, IHT isn't just about what's in your estate when you pass away. Gifts you made in the 7 years before that can be pulled back in.
Ah, yes, the 7-year rule. That's where these PTs come in, potentially exempt transfers.
Exactly. PTs. If you gift an asset directly to another individual, say cash, property, shares to your child, and you live for 7 full years after making that gift, then it's generally completely free of IHT. It falls outside your estate.
But if you don't make the 7 years,
Then the value of that gift is added back into your estate calculation for IHT purposes. There is taper relief, though. If you die between 3 and 7 years after the gift, the amount of IHT due on the gift itself is reduced on a sliding scale.
so the tax reduces the longer you survive after year 3.
That's right. 3-4 years, it's 32% IHT. 4-5 years, it's 24%, then 16%, then 8% in the year before the 7 years are up. After 7 years, it's 0.
It seems designed to encourage giving earlier, but stop people just giving everything away on their deathbed to avoid tax.
That's pretty much the idea behind it, yes.
We should probably just quickly touch on national insurance, NI. Gifting itself doesn't usually trigger it, does it?
Not directly on the gift value, no. But if you're gifting business assets, particularly things like shares to employees, it can have payroll implications.
How so?
Well, receiving shares might be treated as earnings for that employee, which would then be subject to both income tax and national insurance contributions through the payroll system. So businesses need to make sure their payee is updated correctly.
Right. Okay.
Okay.
It really does highlight how important this whole area of gifting is becoming, especially in 2025. You've got these frozen allowances,
Frozen allowances, often rising asset values, especially property in some areas.
and more people are being dragged into paying income tax, right?
Definitely. The number of income taxpayers has gone up quite a bit. So managing potential CGT and IHT through well-planned gifting is becoming more relevant for more people.
Okay, we've set the scene with the main taxes involved. Let's drill down a bit more into capital gains tax now. We said it's based on market value at the time of the gift. How do you actually calculate the tax due?
Okay, so the steps are fairly logical. First, work out the gain. That's market value minus your original cost, your base cost, and also minus any allowable costs, things like solicitor's fees when you bought it, or maybe the cost of a big extension if it's property.
So market value minus total costs equals the gain.
Broadly, yes. Then you take off your annual exempt amount, which is £3,000 for the 2025-26 tax year.
Okay, that reduces the taxable bit.
Exactly. The amount left is your taxable gain. Then you apply the correct CGT rate, 10% or 20% for most assets, 18% or 24% for residential property, depending on your income tax band.
And you have to report this.
Oh, yes. You need to report it to HMRC, usually through your self-assessment tax return. For UK residential property, you might have to report and pay within 60 days.
Are there ways to sort of delay paying the CGT when gifting?
Yes, the main one is holdover relief. This is really important for gifts between spouses or civil partners.
Right.
You can gift an asset to your spouse, and essentially the gain is held over. No CGT is due at that point. Your spouse effectively inherits your original base cost.
So the tax isn't wiped out, just deferred until they sell it.
Correct. They'll pay CGT on the total gain from when you first acquired it, when they eventually dispose of it. But this relief generally doesn't apply to gifts to, say, children or other relatives, unless it's certain types of business assets where a different type of gift holdover relief might apply.
That's a key distinction. Are some assets just completely exempt from CGT anyway?
Yes, thankfully.
Yeah.
Your main home, usually if it qualifies for private residence relief or PRR, personal belongings chattels, if they're worth £6,000 or less when you dispose of them. Things like jewelry, antiques maybe. Your private car is exempt too.
Good to know.
And importantly, gifts made directly to registered charities or certain amateur sports clubs are also exempt from CGT for the giver.
So ways to potentially avoid it, but when you can't avoid it, what are the common traps people fall into?
Oh, there are a few. Valuation's a big one. Getting the market value wrong, especially for assets that aren't easily priced, like shares in a private family company or unusual property.
HMRC checks these.
They absolutely do. HMRC can challenge valuations, and if they decide the value is higher, that means more CGT is due, potentially with interest and penalties. Getting a professional valuation is often crucial.
Okay, what else?
Missing out on reliefs. We mentioned holdover relief, but also things like business asset disposal relief for business assets. People just aren't aware or don't claim them, and they pay more tax than they need to. We see it happen.
That's a shame.
And finally, sometimes people forget the income tax overlap. They gift an asset that produces income, sorting out the CGT, but don't fully consider how that new income stream affects the recipient's tax position.
That valuation point seems really important. What can people actually do to make sure their valuation is solid enough for HMRC?
Well, for property, you'd look at recent sales of similar properties in the area. Get estate agent opinions, maybe even a formal RICS valuation if it's complex.
Okay.
For unlisted shares, it's trickier. You need to look at the company's accounts, its assets, profits, future prospects. Often, you'd need a specialist business valuer to provide a defensible figure. Keeping records of how you reach the valuation is vital.
Let's make this concrete. Imagine Elwin. He's a higher rate taxpayer. He gifts a buy-to-let flat he owns to his daughter, Syand. The flat's worth £250,000 now. He bought it years ago for £125,000.
Okay, so market value $250K, base cost $125K. The gain is £125,000.
Right.
He gets his £3,000 annual exemption. So taxable gain is $122,000.
And he's a higher rate taxpayer, gifting residential property.
Which means the CGT rate is 24%. So 24% of £122,000. That's £29,280 in capital gains tax for Alwyn.
Ouch. Just for gifting it.
Just for gifting it. And for Syand, her base cost, if she later sells the flat, will be that £250,000 market value for when she received it.
And for IHT, that gift is a
A potentially exempt transfer,
Yeah.
a PEAT.
Yeah.
So all one needs to survive 7 years for it to be fully outside his estate for IHT.
Got it. What about business owners? Any special CGT things for them?
Yes, definitely. Business asset disposal relief used to be entrepreneur's relief. This
Hmm.
can mean paying CGT at only 10% on gains up to £1 million lifetime limit when gifting qualifying business assets.
That's a huge difference from 20% or 24%.
Massive saving, yes.
Yeah.
Very valuable. There's also a corporation relief, which can defer CGT if you transfer your sole trader business or partnership into a limited company in return for shares.
Okay.
But the key there is it must be wholly for shares. And again, that payroll point, if gifting shares to employees, make sure payway is updated, get the tax codes right to avoid issues down the line.
Okay. That's CGT covered in some depth. Let's switch focus properly to inheritance tax now. We mentioned PTs, potentially exempt transfers. Can you just recap how they work?
Sure. A PD is basically a gift from one individual to another individual. The key is the 7-year survival rule. If the donor, the person giving the gift, lives for 7 full years after making the gift, it becomes fully exempt from IHT. It's effectively removed from their estate calculation.
But if they die within the 7 years,
Then the value of the gift is counted as part of their estate when calculating IHT. It uses up their nil rate band first. And if the total estate, including these failed PTs, exceeds the available nil rate bands, then IHT could be due on the gift, subject to that taper relief we mentioned if death occurs between years 3 and 7.
right. And you mentioned CLTs too, chargeable lifetime transfers. How are they different? Why the two types?
CLTs are different. They are typically gifts made into certain types of trusts, like discretionary trusts or sometimes gifts to companies. Unlike PHEs, CLTs can trigger an immediate IHT charge if the value of the gift, when added to other CLTs made in the previous 7 years, exceeds the donor's available nil rate band.
So tax could be due straight away.
Yes, usually at a rate of 20% on the excess over the nil rate band. Plus, the assets in the trust might face further IHT charges later on, like every 10 years, or when assets leave the trust.
And why treat trust gifts differently?
Well, the thinking is partly that assets in trusts are sort of moving further away from the individual's direct control and benefit, potentially benefiting multiple generations. So the tax system treats them as a more definite chargeable event sooner, whereas a gift to an individual, a PT, might still indirectly benefit the donor or is seen as a more direct transfer. It's complex policy.
It sounds like it. But there are ways to make gifts without worrying about PTs or CLTs immediately, right? These IHT exemptions.
Absolutely. And using them is fundamental to good IHT planning. The annual exemption is key, £3,000 per tax year. You can gift this amount away, IHT-free each year.
And you can carry it forward.
You can carry forward one unused year. So if you didn't use last year's £3,000, you could potentially gift £6,000 this year, IHT-free.
Okay, useful. What else?
The small gifts exemption. You can make unlimited gifts of up to £250 per person per tax year, as long as you haven't used another exemption on the same person. Think birthday or Christmas presents to lots of different people.
Right.
Then there are specific exemptions for wedding or civil partnership gifts. £5,000 from a parent, £2,500 from a grandparent or great-grandparent, £100,000 from anyone else.
Okay.
And a really valuable one, often overlooked, is normal expenditure out of income. If you make regular gifts out of your surplus income, and doing so doesn't affect your normal standard of living, those gifts can be completely IHT exempt from day one. No 7-year wait.
Wow, that sounds powerful, but maybe hard to prove.
It needs good record keeping. You need to show a pattern of regular gifting and demonstrate that you had enough income left over after all your usual expenses.
Mm-hmm.
But yes, very effective if done correctly. And finally, don't forget gifts between spouses or civil partners, generally completely exempt if both are UK domiciled.
So lots of tools in the box. Strategically then, how can people use these exemptions and gifting rules to minimize IHT overall?
Well, several ways. First, use your annual exemptions every year. Don't waste them. And maybe make those gifts earlier in the tax year.
Okay.
For larger gifts, intended as PETs, making them sooner rather than later starts that 7-year clock ticking. Don't leave it too late if IHT is a concern.
Makes sense.
If you have surplus income, establishing those regular gifts out of income can significantly reduce your estate over time without impacting your lifestyle now. Combining exemptions works too. You could give your child £3,000 using the annual exemption, plus a separate £250 small gift, maybe contribute to wedding gifts, etc.
Layering them up.
Exactly,
Yeah.
layering the exemptions within the rules.
Let's take another example. Rhiannon wants to do some estate planning. She gifts £200,000 cash to her son, Geffen, and she puts £50,000 into a discretionary trust for her grandchildren. What happens IHT-wise straight away?
Okay, the 200,000-pound gift to Gethin is a PEAT, potentially exempt transfer, so no immediate IHT. But if Rhiannon dies within 7 years, that 200,000 pounds comes back into the IHT calculation.
Right, the 7-year clock starts.
Exactly. The 50,000 pounds into the discretionary trust is a CLT, a chargeable lifetime transfer. Now, assuming Rhiannon hasn't made other CLTs recently and has her full 325,000 pounds nil rate band available, this 50,000 pounds is within that band.
So no immediate tax on that either.
Correct. No immediate 20% tax is due because it's covered by the nil rate band. However, it does use up 50,000 pounds of her nil rate band for the next 7 years for any subsequent CLTs, and it will be counted in her estate if she dies within 7 years. Plus, the trust itself now has potential future IHT charges.
So even if no tax is paid now, these gifts have ongoing implications.
Definitely. They need careful tracking.
And for business owners and IHT gifting, we talked about CGT reliefs. Are there IHT reliefs too?
Yes, and a very important one called business relief, sometimes called business property relief, or BPR. This can provide either 100% or 50% relief from IHT on the value of qualifying business assets.
100% relief, so potentially no IHT at all on the business value.
On qualifying assets, yes. Things like shares in an unlisted trading company usually get 100% relief after you've owned them for 2 years. Shares in listed companies or business property might get 50%. It's incredibly valuable for family businesses wanting to pass ownership down.
Wow. So gifting business assets early could benefit from business relief for IHT, as well as maybe business asset disposal relief for CGT.
Potentially, yes. If all the qualifying conditions are met for both reliefs, it requires careful planning. And again, if gifting shares to employees, these might be PETs for IHT purposes, but business relief could still potentially apply to exempt them from IHT even if the owner dies within 7 years. But remember the P or E implications we discussed earlier.
Right. Okay, so let's try and wrap this up. It's really clear that gifting assets in the UK isn't simple from a tax perspective. You've got capital gains tax, inheritance tax, maybe even income tax implications all interacting.
Definitely. It really demands careful planning and, crucially, an awareness of all the current thresholds, the rates,
Yeah.
and those valuable exemptions. They change or get frozen, as we've seen.
And using the latest info, like the March 2025 HMRC and gov.uk guidance we've been drawing on, is vital for making decisions that are actually effective.
Absolutely essential. You need current information.
And I think we should stress what we've talked about today gives a good foundation, a good overview.
A starting point.
But everyone's situation is different. The assets are different, family circumstances, income levels, it all plays a part.
That's exactly right. What works perfectly for Alwyn or Rhiannon in our examples might not be the right strategy for someone else listening. The specifics matter hugely.
So for anyone listening who is thinking about gifting or maybe is already in the process, getting tailored advice seems really important.
I'd say it's crucial, yes, to make sure you navigate all these rules properly and, achieve what you want to achieve with the gift without unexpected tax consequences.
Which brings us back to Pro Tax Accountant, who made this discussion possible. If you do need that kind of personalized guidance for your specific situation, reaching out to experts like them would be a very sensible step.
Definitely. They can help you understand how these rules apply to you personally and help you plan your gifting strategy in the most effective way.
Great advice. Thanks for breaking down such a complex topic today.
My pleasure. It's an important one.